Hello and welcome to the third and final video in our series of interviews with iShares, looking at the fixed income ETF market. I'm Mark Dunn and I'm going to be your host. I'm also the editor of Portfolio Institutional, which is a magazine that focuses on all things investment for pension schemes, insurers, charitable foundations and family offices. Now, the previous interviews in this series have looked at the evolution and modernisation of exchange-traded funds that specialise in bonds, and this final interview focuses on the growing adoption of fixed income ETFs by institutional investors. Now, the good news is you're not going to be hearing my thoughts and insights into this market. For that, I'm speaking to two insiders who know all about it. So let's meet them. Justin, could you start with introductions, please?
Sure, Mark. Hi there, guys. My name is Justin Wheeler. I've been at BlackRock for about 11 years, and I currently lead our efforts around iShares ETF and index fund distribution to asset owners in the UK.
Okay. Thank you, Justin. Good to have you with us. And Sebastian.
Yeah, hello. I'm Sebastian Meyer. I'm a product manager at S&P Dow Jones Indices and covering fixed income indices. Been there for 10 years plus here.
Good. We've got decades of experience with us. Thanks for that. Thank you. Justin, if we could start the questions with yourself. Why have fixed income ETFs become more popular with institutional investors?
Thanks, Mark. I think the COVID sort of pandemic was a real catalyst where we saw scores of institutional investors turn to bond ETFs, many for the first time, in fact, just given their resilience and demonstrated liquidity through that period. ETFs provide that price and exposure transparency and deep and actionable liquidity. And these were important kind of requirements and needs and have been for institutional investors in recent years. In fact, just last year alone, we saw about 41 new clients invest in bond ETFs across EMEA alone, which is really quite sort of staggering. More broadly, though, for institutional clients, the ability to really kind of create specialized calibrations of your portfolio through bond ETFs, capture trade opportunities, or better manage kind of portfolio risk have really been key features for clients. I think that flexibility, that portfolio efficiency has really resulted in bond ETFs becoming a key component of a PM toolkit. And just a few stats to kind of reiterate that. In 2022 alone, we saw 266 billion of new flows into fixed income ETFs in the year alone. And let's remember, this was a year of challenged bond markets. And I think it's testament to how bond ETFs are a vehicle that can be used in really all types of market environments. Over the past 4 years, we've seen just over $1 trillion of flow into bond ETFs, taking total bond ETF assets up to about 1.8 trillion. And lastly, from a volumes and trading perspective across the EMEA industry, we've seen the average daily volume for UCITS bond ETFs sit at around $3.5 billion, which is double what we saw since 2018. So it's quite a staggering kind of growth environment.
Gotcha, thank you. And staying with you, Justin, fixed income ETFs have driven investment in technology, infrastructure, and electrification of the bond markets during the past 20 years. So how do you envisage their contributions in the future?
Well, if you just think about that growth trend that I've alluded to, it's probably not surprising that we're very optimistic here at BlackRock about the utility of bond ETFs looking forward. I think bond ETFs have reshaped fixed income market structure. They're helping to create and drive that electronification, that algorithmic bond pricing, and topics such as portfolio trading. And these are all really contributing to a much more robust bond ecosystem. New product launches are helping clients find that precision from an exposure and allocation perspective. It's helping them create more customizable portfolios to either hedge risks or, again, capture investment opportunities. If we also think about some of the changes that we're seeing around macro and market volatility, the need for a kind of nimble, efficient toolkit and toolset for PMs is proving to be really, really crucial and important. And I think, the natural characteristics of bond ETFs, that liquidity, that transparency, that access is really helping from a portfolio efficiency standpoint and through that lens. And then lastly, we're seeing indexing play and take a greater share of the portfolio design. And I think that's going to be a supportive tailwind around bond ETFs becoming and playing a greater role and becoming a more core component during the portfolio construction process. So I think on the whole, a very optimistic outlook as we think about a number of factors driving bond ETF adoption and its ability to kind of help enhance that fixed income market moving forward.
That's good. Thank you. Thank you. And Sebastian, how does indexing improve portfolio resilience during market downturns?
Yes, thank you. Indices provide a strong level of diversification by virtue of being market oriented and market weighted. The rules-based approach of an index ensures discipline and consistency, which is very critical in market downturns, as it avoids emotions and the temptation to time the market. We run regular scorecards called SPIVA that compare S&P Dow Jones Indices against active investments. These reports show that passive index-based investments are hard to beat in the medium to long run.
Gotcha. Thank you. And Justin, in what ways are you seeing institutional clients utilize fixed income ETFs?
It's an interesting kind of like evolution. And then to the points raised by Sebastian, I think given the volatility we've seen in recent years, the ability to adjust strategic or tactical asset allocation with speed and efficiency has probably been one of the greatest kind of use cases out there. Just two obvious examples is volatility through recent years, the ability to kind of effectively rebalance portfolios for changes in your strategic asset allocation, given the need to perhaps more frequently review that, is helping, ETF liquidity sleeves and ETFs are helping PMs and investment teams action that effectively. But then also when you think about kind of putting a trade on in markets, we've seen a ton of flow back into credit corporate bond ETFs over the past 4 to 5 months as a controlled way to put risk on quickly and efficiently. And again, ETFs are proving a super valuable tool there. So that adjustment of SAA and TA is one clear use case. Another two areas we've seen adoption and growth is around one being ETFs as a complement or a substitute to derivative structures. Typically CDS, for example, has been your traditional place of liquidity management for portfolios, but ETFs are playing a much bigger role there given they're reducing costs over time and some of the operational enhancements they provide over things like rolling futures contracts. They also more kind of are a better representation of the cash markets versus some of the derivative structures out there. And then lastly, a lot of clients in prior years have looked to enhance yield, perhaps in non-core allocations, places like China bonds, EM debt, short-dated credit, Asia high yield, for example. And that's been a place where, again, that precise exposure that ETFs offer have been really valuable for clients from a kind of use case perspective.
Okay, thank you. And Sebastian, the trend towards sustainable indexing is growing. I mean, have you seen institutional investors approach sustainable investing in fixed income?
Yes, as an index provider, we see growing demand for sustainable indices. We see the demand for new sustainable indices, but also many requests to include sustainable criteria in existing indices that are already used for benchmarking. In iBox Fixed Income Indices, we have created ESG indices as well as climate indices, such as the iBox Euro Corporates Net Zero Paris Aligned ESG Index. Thematic indices are also very popular, in particular the iBox Global Green Select Index and the iBox Global Green Social and Sustainability Bond Index.
Great. And Justin, do you have anything to add to that? I mean, how are you seeing institutional investors approach sustainable investing in fixed income?
Yeah, I mean, it's such a huge topic for us across the globe these days. Just kind of relating to some of those topics Sebastian mentioned, the breadth of the ETF platform is really allowing investors, again, to have that precise, deliberate exposure. Places like Paris-aligned benchmarks and Paris-aligned ETFs that we run are allowing investors who have made, for example, net zero pledges to actually have a practical implementation tool to get them on that pathway. And so from an ETF perspective, a lot of our climate solutions have proved very popular with investors. Again, as I say, many of those who have made those big pledges are trying to implement those net zero transition kind of strategies. we see a lot of growth and development and demand for those areas.
Gotcha. And we've reached our final question now. And Sebastian, perhaps you'd like to tackle this one. How do you believe the fixed income ETF options market will develop in Europe?
Yes, as S&P Dow Jones Indices, we see a rising interest in the iBoxx index futures and the iBoxx total return swaps. And these instruments are instrumental to create liquidity and add along ETF options to the liquidity ecosystem that we see in this market.
If you guys have nothing else to add. No, I'd like to thank Justin, Sebastian, thank you very much for sharing your views with us on this quite important and growing topic. And that actually brings to a close our series of discussions with iShares on the fixed income ETF market. And I'm sure we've all learned something. I know I have. So thank you and goodbye.
Thank you very much.
Thank you.